Hello guys, it's that Dividend guy here. Happy Saturday. I've been seeing a lot of what I'm going to do in 2020 type videos, and so I kind of wanted to throw my hat in the ring here and just kind of give you some of the kind of philosophy behind my investment journey and what I've been doing so far on YouTube and kind of what my plans are for the future of my investing career. So, just to give you a little backstory, when I first started on here on Robinhood, in April of 2018, I was buying stocks like Snapchat, GoPro, just cheap ones because I had like $70 in the market. And I was like, I'll just buy what I can buy, right? I didn't pay attention much. So I kind of bought garbage stocks. Nothing against the stocks I named or anything, but they're just not for me. So I just bought stocks that I saw on Robinhood that it recommended for newbies or whatever. And then I started reading investment books. The Intelligent Investor. I read Millionaire Next Door. I read Rich Dad Poor Dad. Just investing books, right? And those really shaped. I've read a bunch of books on Warren Buffett and stuff like that too. But so that really taught me my investing philosophy. So value stock is around a 15 PE, right? That's pretty much what the book ranges it around. So I learned how to value stocks based upon their assets versus their liabilities, and then what their price should be based upon that number. Well, there's more factors, but just keeping it easy there. So I kind of learned how to value a stock. That's what I did. So I didn't care about. I no longer cared about how the market priced it. I analyzed the individual company, figure out what it should be valued at, for the assets or the price to book value, or what the company's actually worth in the numbers versus what it is on the market. So if I can analyze the stock, figure out that, say, Coca-Cola is worth 44 and it's trading at 40, so it's a deal, versus if it's at 45, I stay away from it. That's really how I started shaping my investment philosophy. So I started looking for what they call dividend aristocrats, which are stocks that have paid for 25 years. So I'm 24. So those stocks have paid for my lifetime plus a year, and they have paid and increased their dividends for 25 plus years consecutively. So, year after year, they're increasing their dividends for 25 years or more. And then there's another class which is even higher, which is they are called dividend kings, and they have paid their dividends for 50 plus years, so double what the aristocrats have done consecutively year after year after year after year. So that was intriguing to me. So I thought about it, and I'm like, well, I don't want to, according to the value investing strategy, I'm going ahead and I'm valuing these stocks myself. So I don't care what the price is, because it doesn't matter to me whether they fluctuate or not, because I know what they're worth, or I'm estimating what they're worth. So I'm not going to just take what the market gives me, right? I'm not just going to keep on buying it at whatever price the market says. So I learned how to value the stocks, so I wasn't dependent on the market telling me what they were worth. I did the research to figure out what they were actually worth to me. So I learned the value proposition. Then I went and I learned what the dividend, how dividends were paid, what they were. And so I decided that my investment philosophy is going to be, I'm going to learn how to value a company. And then I'm going to take that value and compare it to the dividend. And as long as it beats inflation, I'll invest in it. And if it has a good track record of increasing, then I'll buy those stocks, saying the aristocrats and the kings, at a value investor's bargain. So I'm gonna buy them undervalued, but I'm going to get the consistency of the dividend payments. So that's the whole philosophy, is I'm value investing, but I'm applying it to companies that are going to grow and pay me over time as long as I hold them. Because I have a really long investment horizon, right? I have about 40 years, about 41, 42 years before I'm going to be able to retire. So I want to be able to build wealth while I'm waiting to retire, right? And again, I'm going to have a 401k, that type of thing. Might have Social Security, but I don't want to put all of my money, or the biggest chunk of my money, into something like a savings account, because that's not going to make me any money. In fact, if inflation's above 2%, you're actually losing money to inflation. You just don't realize it, because the value of your bank account doesn't go down, but as the more money they print, the less valuable the money that's already out there is, right? So you're losing money to inflation. And so since I could research and find companies that I felt were good value, that were going to last, and had a good dividend growth streak, that were valued properly and beat inflation and it was going to grow my wealth over time because year over year I should be getting paid more money. But I'm going to do that for 40 years, then I wouldn't even need a 401k or Social Security, or inheritance or whatever may happen later on in life. I can retire just off my dividends. So that's my goal. That's my whole investment philosophy, is finding undervalued stocks that have a great dividend track record, that have the potential to pay me into my retirement, or at least, for a decent chunk of years. So that's my goal for 2020, is I'm going to find undervalued stocks based upon my calculation. I'm going to take advantage. I'm going to put some money into them, and I'm going to let the money grow. I'm going to buy and I'm going to hold them. So that's my way of investing. Now, I'm not saying it's the best way, or I'm not, Warren Buffett or anything like that. I just wanted to share my philosophy and kind of tell you what my goal is. So from here on out on this channel, I will be buying stocks I feel like are at a good value, that have a great dividend growth history, or a great value plays, because it's a value growth kind of hybrid strategy here. So that's my goal for 2020, is to buy undervalued assets and let them accrue into their actual, what I feel like their value should be, and I'm going to get dividend money along the way. So I'm not going to be enslaved to the market's pricing or the market's value of a company. So that's my goal for 2020, to buy undervalued assets and let them accrue price-wise and rake in the dividends. And then once they're overpriced, like say my AT&T and AbbVie, then I'll find other stocks to invest in. So real quick, I'm just going to show you the strategy in action. So there's a few stocks that could be over or above where I bought them, but let's take a quick look here just to give you an example of what I'm talking about. So for Altria Group, I believe I had about a $42 to $44 fair value for them, and they pay a really good dividend. They are a dividend king, I believe, or they're really close to it. I think they technically should be, but they broke off with Philip Morris, so there's kind of a split there. So I think that they are almost, if they're not a king, then they're really close. I think they're considered a king, but it's kind of convoluted since they broke off. They split that company. But so they pay a great dividend. They've been paying it for 50, I believe 50 or 50 plus years. I think they just hit 50 this year. So I bought 97 shares at $45 a piece. So my fair value was 44-ish. So I bought it a little bit above where I thought fair value was going to be, but that's okay. They are now up for me about $5 a share, a little over $5 a share. So I'm up almost $500. So as you can see, even though I bought a little bit above my fair value, I'm still safe. They're still below where I bought them. Excuse me, they're still above where I bought them. And I'm still raking in dividend money, right? So that's really the goal here, is to buy an underpriced asset, which I did buy this one a little overpriced from my calculation, but it's still underpriced by the market where I bought it at. It's grown since I bought it, and I'm getting about $80 in dividend income, or it's like 75 now. Close to $80 of passive income from Altria Group every month that it pays me. Next, we have Coca-Cola. So my fair value for Coca-Cola was something about $48 to $50. And again, I bought it a little overpriced. But again, it's grown to $55 a share. So I'm up $4 a share. I have 10 shares. So it's about, it says $70, but, 17 shares, sorry. So I'm up $72. So about $5 a share there. Sorry, $4 a share there. AT&T, this one's really been good to me. So I bought it in the middle of its high and its low, and I bought it at $31.10. It's my average price for 62 shares, and I bought this right when I bought the bulk of my stock anyway, right when they announced the Time Warner acquisition, and so their assets hadn't really been priced in the stock. The stock got hit because of the acquisition. So usually when a stock gets when a company buys another one, or it becomes an acquisition, the company that's purchasing goes down. The company that's being purchased is going up. So that's what happened here. So AT&T went down. I bought it. I saw it as a buying opportunity, and now it's up $8 a share. So and I think it's still pretty much a value play. Yeah, pretty close. It's $17. So I would consider it still a pretty good value play, even though it's run up. So I got it below value investing strategy, or the principle, And then I applied it, bought it, and now I'm up. So not only am I up on the stock price, I'm also up with dividend income. So it's working out. Next, I think this one's the biggest one in the portfolio, if not its target. So AbbVie, I bought it at 72. They, just like AT&T, did an acquisition, so they went down, the other company went up. And I'm up over $1,000, but I'm also getting about $70 from dividend income as well. So between AT&T and AbbVie, I'm up about $1,500, I believe, because I bought them low, and I'm getting about $102 every in that month from both of these companies paying me. So now I'm getting appreciation of the stock and I'm getting dividend income because I bought it at a deep value. I saw that, and now I'm being paid for it. So if you buy something undervalued, like a Dividend Aristocrat undervalued, then you can wait for it to appreciate, because generally if it's big blue chip, it will go back up, and you get dividend income while you wait. So that's why I really love this strategy. The next one, Tanger, I think I'm up a little bit, 1484. Yeah, but only 15. I only have 3 shares, so it's not as big. But I'm still making, I'm still up about 78 cents, and I'm getting 35 cents a share. So I'm making over $1 from this place still. So see, I'm still making money on both the price of the stock appreciating and the dividend income I'm getting passively. Walgreens, this one always seems to be up. I only have 1 share, bought it at 54, and I bought it closer to its low than its high, and I'm also raking in dividend income. Next, we have ExxonMobil. This is the only one that I think I'm actually down on, which, again, every strategy has its flaws. I just wanted a big company to pay me. That was, I thought, a fair value at the time. And, you can always be wrong about it. I had about a $72 fair value for this stock, and that, according to the 52-week high and low, that's about 12 to 15 bucks. I'm like right in the middle, right? So I'm about 10 bucks below the high, about 16 for the low. So I'm like right in the middle there. So I bought it a little overpriced, which is fine, and it's coming down. But here's the really fun part about being a value dividend investor, is that since it went down, I can buy it again. And I do have 29 shares, so it's not going to lower it a lot, but it still will lower my average price. And my dividend yield's higher, so I get paid. Technically, I pay less for the same asset that pays me more. So if the price is lower and the dividend's the same, so like if you, to kind of put it in perspective, if you were to go out and buy an iPhone for $1,000, right? And then the next day, the same iPhone, same features and everything, is 500 bucks, or say 200 bucks cheaper, you'd buy it, right? It'd be like, no duh. So since I was comfortable buying it and had the fair value around 72, now it's below my fair value that I calculated, and I'm still getting the same value out of the stock or out of the asset. So the iPhone is still the same, the dividend yield's still the same, but I'm getting it at a better value, and it's going to be paying me more. So it's awesome. I love when dividend stocks go down, especially ones that I'm so bullish on. Next, we have the big runner-up for the portfolio. So AbbVie and AT&T did really well, but this excuse me, this year Target was just like destroying. So I got into Target because I learned it was a dividend king, and I thought it was a pretty fair play. It's a discount retailer, not a big deal, pretty big, right behind Walmart. And so I bought 10 shares. I wish I would have bought more now because it's super up. But anyway, so I bought it at $87 a share. So its 52-week low is 64. So I bought it about $20, 23 bucks above that. But its 52-week high is 130. So that's a $70 difference. So I bought it pretty much in the middle, just like I would say for AbbVie, a little bit closer to the top on this one than the bottom, right? Or excuse me, a little bit more closer to the bottom to the top, because it's got such a huge range for trading this year. So not only am I getting, what was the appreciation, $400 of a total return because it's up so much for my 10 shares, but also I'm getting 64 cents a share. So I'm still making $6.40 every time the stock pays me, but it's run up so much now I'm not going to buy it. So the issue that you run into with being a dividend investor like I am is some of the stocks that you hold are going to go up. And a lot of them, as I go for the percentage gain loss, a lot of them, almost all of them, are up, right? So especially AbbVie, AT&T, and Target, I'm not going to be using those dividends to reinvest because they're overvalued in my according to my calculation anyway. So then you have to find other stocks to put your money into. So I have a lot down here. I have them organized by price, which you guys can't see, but so I have them organized by price. And so my goal for 2020 is to find an alternate stock to put them in that I can afford currently. So right now I'm making about $80 from Altria. So I could buy, say, a couple Macy's stocks, and then I believe VTR. So I could buy both Macy's and VTR with that dividend. So see what I mean? So I'm gonna find a cheaper stock. Like say I have Macy's for the first of the month, and I have AT&T or SKT, and then for 3 I have Levi's. So I have alternate options because for the third month of the year I only make about $32 in dividend income. So it's not as big as the first two. So I'm finding an alternative. But still, I think that's a great strategy because then even if I can't afford the ones that are paying me, right? I can't reinvest because the stock's too high. I have alternates that I can start building and doing the same thing. So the overall, the strategy for 2020, just like it was in 2019, is to buy undervalued assets, let them appreciate and realize their value, hold them, and keep the dividend income going. And the real goal is to have enough in a stock to reinvest into it. That's the goal. Is to have enough dividend income from, say, Altria or Coca-Cola that I can buy another Altria share, and then with the leftovers from the Altria share, I can buy something like, say, a Macy's or a Levi or VTR, just reinvest into something else with the extra that I have from the dividend income. So anyways, guys, that's my goal for 2020. Same as 2019, but I figured I'd kind of just refresh and kind of, respout my philosophy because I think it's really important, and I wanted to show you guys exactly how I've been doing it this year with a couple of stock picks that have really worked out for me. So thank you guys so much for watching that dividend guy. I really do appreciate everybody who's been subscribing to the channel, and I'm so thankful for it. But 2020 is going to be the exact same. Hopefully it plays out relative to this year. If not, if it goes down, phenomenal. Like I said in the video, my stocks go down, I buy more. So value investing mixed with dividend growth is my strategy for 2020. So thank you guys so much for watching. Like I said, thank you for tuning in and hitting the subscribe button, commenting down below. Let me know, do you guys agree with the strategy? Do you have a different take on it? Maybe you go for different stocks or whatever. Maybe you're a growth investor. Maybe you're a Tesla investor. Whatever it is, let me know down below what your plans are for 2020 and your investing career. I would love to hear from you guys and talk about it. I love the discussion I get on these videos. So thank you so much for watching again, guys. And I will see you in the next dividend investing video. Take care.